Okay. To students, to our friends, to our colleagues, I would like to begin tonight's proceedings by acknowledging the traditional custodians of the land on which I'm presenting, the lands of the Wurundjeri people of the Kulin Nations, and I pay my respects to their elders, past, present, and those emerging, and to all Indigenous peoples and Torres Strait Islanders who are witnessing this presentation. I'm Professor Donald Bates. I'm the Chair of Architectural Design at the Melbourne School of Design and the Associate Dean for Engagement at the Faculty of Architecture, Building and Planning at the University of Melbourne. MSD at Home is our online lecture and event series from ABP. Melbourne Speaks is the opportunity for our senior academic faculty to address the wider public with an insight into their research, academic and professional interest, and to make a presentation on significant issues as part of our intellectual and social engagement. It is my great pleasure for this session of MSD at Home, Melbourne Speaks, to introduce Professor Piyush TIWARI, Professor of Property at ABP. Prior to his current position, Professor TIWARI was Director of Policy at the Infrastructure Development Finance Company in India, where he was responsible for formulating policies for private financing of urban infrastructure in close cooperation with national and state governments. He was also editor of India Infrastructure Report 2011 and on Water. Earlier, he was Senior Lecturer Property and Program Leader for the MSc International Real Estate Markets at the Business School at the University of Aberdeen in the UK. He has held positions at the largest mortgage company in India, HDFC, and at the University of Suzuka in Japan. His research interests include infrastructure policy, housing economics and mortgages, commercial real estate investment, and financing infrastructure in developing countries. He has published numerous research papers on issues related to real estate and infrastructure. He has published a book titled International Real Estate Economics. He is a member of the Royal Institute of Chartered Surveyors. His other professional activities include acting as director for the Asian Real Estate Society and associate editor for International Real Estate Review. His presentation tonight is titled On Bank Pricing of Single-Family Residential Home Loans in Australia. Please welcome Professor Piyush TIWARI.
Thank you very much, Professor Bates, and thanks for the kind introduction. May I share my slides? Today, I will speak about the efficiency in residential mortgage pricing by Australian banks. There's a general feeling that besides having overcharged on fees, the banks in Australia have also been overcharging on interest rates. Though it is difficult to test and has therefore not been examined by the Australian Competition and Consumer Commission, as well as the Royal Commission on Banking, but it's an interesting area to investigate, and that's where we would try and look for some evidence on the pricing of mortgages in Australia. This research is based on last 1.5 years of study that I conducted with my colleague, Professor Jim Schilling, who is at DePaul University, Chicago, currently probably anxiously waiting for who their next president would be. But it's an important and interesting approach that we adopt in order to give or get some more insights into the mortgage pricing. So the motivation for this research comes from two major inquiries that were conducted. One was by Australian Competition and Consumer Commission, which conducted residential mortgage pricing inquiry and submitted their report in November 2018. This inquiry found that there is an opaque discretionary pricing which the banks follow, which causes inefficiency and stifles price competition. In other words, there is some sort of market dominance by few banks, which results in inefficient pricing. The other important finding was that there is a heavy reliance on brokers and aggregators to gain market shares. Most of these banks use brokers and aggregators in order to sell their mortgages, which again leads to inefficiency. In a competitive market, one would expect that the prices of loans are determined in a competitive way, depending on the cost of funding, depending on the liquidity in the market, and so on. But the big four banks focus largely on each other in setting their variable mortgage rates for their main brands and do not appear to have meaningful regard to the pricing decision of small lenders. Then there was a follow-up Royal Commission into misconduct in banking, superannuation, and financial services industry, which submitted its report in February 2019. Though it had much larger scope, but one thing that is more relevant to us is that they recommended that the broker remuneration structure be reformed significantly. Now, this forms the basis for us to also start questioning whether the mortgage pricing or the mortgage interest rates that the banks have charged have been efficient, given that they have significant market share. Now, if we look at where Australia is in terms of the level of debt as well as home ownership. So what we see here in the picture, which is on the right-hand side, you can see my cursor here, that the household debt to income ratio in Australia is somewhere around 200%, which is among one of the highest internationally, much, much higher than the US or the UK. So which means that the households in Australia are holding quite a significant debt on their balance sheet. If we look at the total outstanding mortgage debt, by 2018 December, it was about 1.8 trillion. This is just about a little more than the GDP of the economy here, which is spread across 6 million loan accounts. Nearly 1 trillion of this outstanding debt originated in last 10 years, between 2007 to 2018. 80% of this debt was originated on behalf of 4 large banks, and most of it, almost 80 to 90%, variable rate mortgages. The variable rate mortgages are those where interest rate changes with some index as per those index changes. Now, this particular graph here shows how the Australian housing credit has grown over a period of time. Today, it stands somewhere around 1.8 trillion, 1.8, a little more than 1.8 trillion. And much of the growth has come after 2003, you can see here. Before that, it was a very small component. And each quarter adds roughly about 20 billion in new loans. So the question here is that are Australian households paying too much on their loans? Now, here, what would be of interest is that to what extent is that due to inefficient pricing that the banks adopt? So what we do is we adopt an innovative method to investigate that. So we construct a rate, which we call it as synthetic rate. The interpretation of that synthetic rate is that this is the price Australian banks should charge on their variable rate mortgages in light of their own financing of fixed rate mortgages. Now, it will be important for us to understand what is the difference in terms of risk between the variable rate mortgage and the fixed rate mortgage. Now, fixed rate mortgage in Australia remains where the interest rate remains fixed for a period of time, usually, let's say 3 years. So if the interest rate is fixed for a period of time. The lenders take risk which is related to interest rate risk. They also take risk which is related to prepayment risk, and of course the default risk. Now, if there is a loan which is based on variable rate mortgages, where the interest rate moves as per the market, the interest rate risk doesn't arise. The prepayment risk also doesn't arise. So there is a difference between VRMs and FRMs. Now, if we know what an FRM is at the moment, and assuming that banks have priced their fixed rate mortgages, incorporating all those risks, then we can construct by taking out the risk premium that they have assigned to fixed rate mortgage, what a synthetic or the variable rate mortgage equivalent should be. So that is what we construct here. And then we also look at if there are differences between the synthetic variable rate and the actual variable rate, what they actually charge. How can we explain that? There could be reasons. There are a number of factors that go into determining the actual variable rates. And these are related to liquidity in the market. If liquidity is high, obviously the interest rates would be low. If liquidity is low, interest rates would be higher. And there could also be default related risk, or there could be other risk if the borrowers are highly indebted, which means the debt to income ratio is quite high. Obviously, banks would assume that those borrowers are risky because there is too much debt on their balance sheet. They would charge them a higher rate. So there could be those economic reasons why the actual rate might be more than the synthetic rate. But if we control for all this, would there still be a difference? And if it is, which cannot be explained, that causes a problem. So before we do that, let's try and understand what are the institutional characteristics of mortgage market. There is a dominance of 4 banks who are largely funded by deposits of short-term duration. The variable rate mortgages, they dominate the market, which track cash rates. The FRMs are short-term and usually fixed. Generally, they are 3 years, 2 years, or 1 year fixed rates. Now, FRMs are pooled together and sold in the secondary market as mortgage-backed securities. There are a number of different complex products. Even the Competition Commission had also pointed out that there are wide range of products which are available, which makes it difficult for borrowers to make choices. So there are basic loans, flexible loans, discounted loans, and numerous versions of these. Mortgages are underwritten solely on the basis of the ability to pay back the loan of the borrower. So though we have restrictions which are related to mortgage repayment capacity, but usually banks will go depending on what the borrower's ability to pay is. The loan to value ratio has some variability. In 2008, it used to be around 62%. In 2018, it's about 73%, though it was much higher in 2013. Now, one could always argue why it has declined from 78 to 73%, because many of the first-time home borrowers, they have withdrawn out of the market, which has caused the loan to value ratio to decline a bit. The typical loan term is about 25 years. It could range between 20 to 30 years. Now, if we look at how the bank's market power has changed, since 1980s, the major retail banks have increased their market share quite significantly. And the most usual way to increase the market share is through acquisition of smaller banks. There is also an issue related to entry into the mortgage market for a newer bank. There are barriers there because the data on consumers are held by these major banks generally because they hold the major market share. So the cost of entry is quite high. And the financial literacy among the borrowers is quite weak. Now, if we look at the growth of investor-owned housing loans and the owner-occupied loans, now the blue line here shows the growth rate of owner-occupied loans and the orange line is the investor loans. So up until 2014-15, the investor loans grew quite significantly, much larger rate than the blue, largely because of negative gearing. After 2014, a number of regulations came in order to check the growth and restrict lending for investor housing, which has caused some sort of leveling out. This I've already mentioned, that there are various types of loan. There is a basic loan, which are generally fixed rate mortgages, where the term is fixed for a certain period. And there are a number of variable rate mortgages, and there are a number of features associated with them, such as offset account or redraw, and so on and so forth. So it makes the whole market quite complicated. A number of regulations which came in, given that affordability was an issue, given that investor lending was growing at much faster rate. So a number of regulations came around 2014 to 17 in order to curb these growth. If we look at the literature, what does literature say of what would happen to pricing if there is a concentration of banks? Literature suggests that banks may collude and it may affect the price of loans. But one could also argue that prices are inflexible or sticky. They don't change quickly because it may give wrong signals to the borrowers. It may cause confusion amongst the brokers and so on. The other issue that the literature talks about is if there are regulatory restrictions to competition and monopolistic power, it will create an environment where few powerful banks would stymie competition. And this will have an impact on the efficient pricing. Another view is that the bank's concentration, if there are more efficient banks, it may actually reduce the cost, and those banks will garner more share. So there are different kind of views which have been proposed in the literature. Then there is another interesting paper which suggests that monopolistic banks, they prefer a risky credit policy to a less risky credit policy. What would be a risky credit policy? Lend to riskier borrowers, charge high interest rates, and so on. Matsuoka in 2011, in his paper, comments that banks with market power have profits that are positively correlated with nominal interest rate. So as the interest rates are going up, their profits would be positively correlated. Now I'll come to this point again towards the end of my presentation, where I will share one slide on how banks in Australia have performed in comparison to their competitor elsewhere in the world. Now then, what does mortgage securitization do? If again, there is a monopolistic market, the mortgage securitization could lead to segmentization of borrowers, which would basically means that even the high credit worthy borrowers could be charged much higher interest rates than what they should be. What does literature say about Australian bank? There are two extreme ends. One is by Bell and Hinmore, who suggests that Australia avoided 2007-9 global financial crisis, and banks were able to avoid that. And this was because the Australian banks were boring but safe. They were prudent lenders to some extent. Morgan Stanley, on the other hand, says that the return on capital for the major banks in Australia is much higher than their peers anywhere in the world, be it US, Sweden, Singapore, Hong Kong, anywhere. So this extra profit has to be earned somewhere. So how do banks price their loans? There are multiple headline rates. There are discretionary discounts. Sometimes these discounts are based on borrower's risk profile, where they are located, the value that the borrower brings to the bank. If they have multiple products, they are customer for multiple products, or they have opportunity to sell more than one product, banks would probably give them more discount. The complexity leads to origination through brokers. Much of the loan is originated through brokers. And there's, of course, huge market power. So what we did in this research, we constructed a synthetic mortgage rate. As I said earlier, in order to construct synthetic mortgage rate, which is a synthetic variable rate, we adjusted the fixed rate mortgage for call risk, which is a prepayment risk, and the interest rate risk, because that's the differentiating factor between a variable rate mortgage and the fixed rate mortgage. That the fixed rate mortgage comes with a prepayment risk and the interest rate risk. If we can adjust that, then we will be able to construct what a synthetic mortgage rate should be. And we are looking at banks' own pricing of their fixed rate mortgages in order to come up with what the synthetic rate or synthetic variable rate mortgage pricing should be. Now we use what we call it as swaps. These are derivatives. Now these swaps allow swapping one type of cash flow with another, particularly the fixed cash flows with a variable cash flow. Now, Australian homeowners, they can take out a swap. Now, suppose here is a bank from which they have borrowed at a fixed rate. Fixed rate would require that for the period for which loan is fixed, they have to make a fixed payment back to the bank. Now, this cash flow, they can swap with a counterparty who then pays the Australian homeowner a fixed rate in exchange for a variable rate that Australian homeowners would pay to this counterparty. Now, this variable rate is tracked on cash rate plus some premium, depending on the asset that is in question here, housing. So here, for some notional amount, it's possible to write a swap where an Australian homeowners could exchange their fixed rate commitments with a variable rate commitment. And this counterparty can pay this fixed rate, which can then be paid to the bank. We also use another derivative, which is called swaption. So swaption is an option to receive fixed and pay floating rate. Now, excuse me. This allows the Australian household to exercise an option when they think it's beneficial for them to enter into a swap. So here we use 2-year call swaption. So a 3-year prepayable fixed rate mortgage in Australia is essentially equivalent to a variable rate mortgage plus an interest rate swap and a swaption. Now, if swap rates have fallen, which means that if the variable rates have gone down, then Australian homeowner would exercise the swaption because it makes sense for them. They will benefit. There will be a profit to be made there. So if we translate this story into a very simple function, what we are saying here is that the synthetic rate, which is represented here with Y, should be equal to, this is the opportunity cost of lender's money for 1 year, which is, let's say, 1-year bond yield, plus a spread. Spread is the risk premium that is attached with the term of the loan. In this case, in the fixed rate mortgage, if the term is 3 years, so this is that spread. How much kind of premium would you associate for holding the interest rate fixed for 3 years? And SW is the swaption, and P, we add another term for the default risk. Now, without getting into too much details of this, let's try and do some simple calculation here. Now, let's say the 3-year mortgage rate, 3-year fixed mortgage rate is 4.15%. This is as per March 2018 actual numbers. So in March 2018, the fixed rate mortgage for 3-year fixed rate was 4.15%. One year I1, which is the 2-year government bond rate, was 1.99%. So the government bonds don't have any risks. So they are essentially the risk-free. And if it was a 3-year government bond, the rate was 2.18. So the difference between the two, 2.18 and 1.99, is the premium that is associated with the term. Then we have swaption. This is the premium that one pays to hold a swaption, which is 0.63 on March 2018. And this is the default premium. So if we calculate based on these numbers, the synthetic rate comes to about 3.39%. But what banks were actually charging was 5.20%. This simply tells us that there was 1.81% additional charge that the banks levied on mortgage borrowers. Now the question is that there could be two reasons for this additional. One could be that it's economic reasons of liquidity and so on, or it could be mispricing. Now, this particular picture here shows how the difference between the actual variable rate and the synthetic rate that we have calculated has been. So the gray line here is the actual variable rates that banks have charged over this period, 2008 to 2018. The blue line here is the synthetic rate that we calculated, where we did not include swaption, and the green line is where we include swaption. So you can see here between 2008 to 2018, the deviation has been quite significant. So which gives the doubt that the banks have been overcharging the customers. Now the question is that let's test this hypothesis a little further. So what we do here is to then test whether synthetic rate is an unbiased predictor of actual variable rate. If it is, then you would expect that whenever there is a change in synthetic rate, the actual variable rate should also change in the same way. So the difference between the two could arise for a number of reasons. One, that there are differences in credit risk, loan characteristic, funding and service cost, and other characters, which are all like economic prudent reason for the difference to arise. Or the other could be that there are imperfections in the financial market. There are barriers to efficient flow of funds and less than perfectly comparative lending conditions. So we do a test for overpricing. Now again, this looks quite complicated, but it's a very simple way of testing. We conduct a standard partial adjustment model where we are saying on the left-hand side is that if this is the interest rate, variable interest rate in the last period, and this is the interest rate in this period, the difference between the two, how it has changed, this should be a function of previous period interest rate and how much does it deviate from this period's synthetic rate. Lambda is the coefficient that tells us how left side adjusts to the right side. Now you would expect this to be as close to 1, right? The reason is because you would expect that if the pricing is perfect, then this should have been captured in the synthetic rate as we described earlier. There could obviously be difference because synthetic rate is needs to be adjusted for the liquidity risk and the credit market risk, which we do here. What we find here is an interesting story. But before I do that, let me explain this particular graph before we show the findings. So here, this particular graph is the household interest payment to income ratio. Now you can see here how interest payment to income ratio has increased, and it's quite substantial, almost 7%. So a large part of period between 2013 onwards, it has started to increase here. Despite the fact we know that the interest rates have been the lowest. So part of this, you could, this basically is moving along with the variable rate mortgages, which are tracking the cash rates. So the cash rates have been low, so it should be low, but here it has started to increase, despite the fact that the cash rates have been low. Household credit annual growth is about 5%, and it has been around that for last 5 to 7 years. So what we find here in terms of our results is that the speed of adjustment, the one which I was saying, talking earlier, lambda, which was that how quickly the deviation between synthetic and actual rate adjusts to actual minus the previous period's actual. The speed is about 0.72 to 0.79. What does it mean? That only it takes few quarters before the actual variable rate adjusts to the deviations in the market. We also find that the difference between the actual and synthetic mortgage rate in Australia is between 90 to 150 basis point. What it means that the banks have been charging 0.9 to 1.5% more than what they ought to be. So the key message here is that even after specifying for all non-linearities and interaction in the pricing of variable rate mortgages, as well as measure of swap rates and swaptions precisely, a large part of difference between the actual and synthetic rate mortgages remain unexplained. So which is between 90 to 150 basis points. Now, each extra basis point in mortgage interest rate cost Australian mortgage holders about 180 million per year. So a 90 to 150 basis point excess cost Australian borrowers 16.2 billion per year. Now you can understand the implication that this has for housing affordability. Now, low interest payment to household disposable income could have improved housing affordability. Now, increased housing affordability has other benefits. It would have reduced financial stress. It would have strengthened couple stability. It would have benefited school enrollment. It would have increased home maintenance and gardening. All this we have foregone because the price has been inefficient. Now this, again, I'm coming back to the point which I made earlier, how Australian banks' profitability has been. This is return on equity chart from Bloomberg. Now these are the banks in different countries. Now at the top are Australian and Canadian banks. You can see that up until 17-18, both of them were, the return on equity was about 17-18%. After that, for Australian banks, it has declined partially because of the Royal Banking Commission as well as the interest rate. And what we see here is that compared to their competitors elsewhere in the world, this is quite significantly high. Now, the two observations that I want to make before, while concluding, one is that the predominance of VRMs, the variable rate mortgage, in the words of Virginie Lower, is that they seem to be mainly at the lenders rather than borrowers' initiative. And what they suggest is that consumers must be bribed to accept variable rate. The sweeteners, lower base rate, discounts, caps on rate increase, all this are the sweeteners in order to entice borrowers into taking variable rate mortgages. And when variable rate mortgages are the dominant form of mortgages, the banks maximize total asset. They keep on growing the number of loans rather than enter into a normal constraint optimization. And I'll stop here.
Wow, thank you, Piyush. That's our Professor Tiwari. I'm going to be more formal than that. That's fantastic. I mean, I was just noting I have 4 pages of questions that I've written while you've been talking, but I want to make a disclaimer before we proceed further, which is to say that I'm probably the least informed person when it comes to questions around financing, issues around how financing is structured and so on and so forth that you can imagine. So everything I'm going to say is not from an academic point of view. It's purely from a kind of consumer point of view. Somebody who, has a residence and has looked at the property market and tried to deal with the property market and such. But there's so much that your presentation raises, and we've started to receive a few other questions, which I'll get to. But I want to go back. I mean, I'm not quite sure where to start because my notes are sort of all over the place. But I guess the first one, in a broader context, is I want to understand is, in terms of your research, the question of specificity. I mean, because on the one hand, there's comparability. The last chart that you showed was comparisons between Canada, Australia, the UK, Singapore, America, and so on and so forth. And so when we talk about different, both banking systems, but also the relationship to, I mean, at the end of the day, your project is about housing. So this whole question of financing of housing and, housing as both an economic lever, but also a place to live, a place that you stay. And so I'm curious in terms of I guess my first question would be, do you think that the Australian context is both quite unique and therefore it has both unique advantages, but also disadvantages in a comparative relationship to particularly the ones you showed? But I would also ask it relative to places, not just the UK or Singapore or America or Canada, but also Germany or France, for instance.
I think it is because one is the dominance of the banks here, and 80 to 90% of the mortgage market share is by the 4 leading banks. And that is quite different. That even the Competition Commission, when they did the inquiry, they found that when the banks were pricing, even though there's no evidence of tacit collusion here, but they were adjusting their pricing by looking at each other. So the pricing in that sense becomes not a competitive market instrument, but rather a kind of some sort of colluded instrument here, which is different than other markets where the competition is far more evident in terms of pricing. And that then has its impact on home ownership and other kind of market evidences that we see here.
But in carrying that forward, then, so if we make a comparison, I mean, in the US, obviously, the scale and size of Australia is not even the size of someplace like Texas, much less California or New York in terms of population and therefore, what the market may be. So can we say that Australia with the big 4 is a consequence of effectively a physically large country, but effectively a small population? But then you compare it to some place like Singapore, which itself is what, a total of 6 million people maybe. So does Singapore have a much more diverse kind of ecosystem of banks and financial instruments than, say, someplace like Australia?
I think that's quite right, because Singapore and Hong Kong, they are the 2 examples where you have international banks as well as the domestic banks who compete with each other. And that creates an environment within which the pricing is efficient, compared to here where there is the presence of international banks is hardly any. And most of these banks, they have grown over a period through acquisition of smaller banks. So smaller banks who have just about 15-20% of the market share, their pricing doesn't even compete with the major banks. So that causes a problem. So there is, what you're suggesting is that the competition is, yes, stifled here. The size doesn't matter. It's the market conditions that are important here. One can have fewer banks if with proper regulation, you could instill the competition.
So are you saying then that the lack of diversity in the offerings that are made to consumers is a consequence of effectively a lack of regulation or a lack of opportunity? I mean, so is it, that the regulations don't allow more diversity, or do the regulations only prop up the sort of quote unquote big four?
I think the regulations haven't been effective in enhancing competition amongst the banks. So they have always been reactive in some senses, and that has caused the problem. Regarding the offerings to the borrowers in terms of mortgage products, there are many. And that causes another problem because the borrower is unable to distinguish one product from the other in terms of which one is more cost efficient. So like, for example, what we have is that most of these banks will have headline rate, and they will have all those different types of discounts. The transparency of those discounts and how they are applied is never revealed, is not clear. So that causes a layer of inefficiency. So I guess what your question is that whether regulation have lagged behind, answer to that is yes, it has, which has then affected the way the mortgage has been priced in the market.
I mean, it reminds me, I know that, if you decide to buy a mobile phone,
Yeah.
and you go to, whether it's Telstra or Optus or any of the other, it's almost impossible to compare offerings.
Yeah.
Because it's both about how many megabytes you get, what the phone is, what the duration is, when you pay it back, how much you pay if you go over your rates, and so on. So on. So it seemed to me that there, either somebody needs to come up with a sort of algorithm that can make comparative analysis. So it seems that it's the question of comparative analysis of, in order to judge like for like, to be able to make an educated choice, because right now the differentials are so diverse that you can't actually even compare one thing to another.
Yeah, absolutely. And what would you do in that case? And in that case, what happens is you would rely on a broker who you would think that probably this broker has much better information than I have and would be able to advise me in order to make that choice. But if then the brokers and aggregators are closely associated with some banks, it leads to another layer of inefficiency, because then the decision that you are making is not a comparative decision, but it's more like a directed decision, which could then have an impact on what you pay on your mortgages. And that's the story of Australian mortgage industry.
I'm going to take one of the questions right now. I mean, I have so many others, I'll come back to them, but I want to take one of the questions. There's a question here, it says, what are the regulatory processes that can be employed to manage this difference, this gap, in the cost that the banks are charging? And is there a role that the architect can play in mitigating this on an economic level?
First, let me take the second question first, which I probably would not be able to answer. What role can architect take in mitigating this? The first one, yes, definitely, there is a role that regulation can play in order to mitigate some of the situations that we are witnessing in that sense. And the enhancement of competition and transparency in revealing the price as well as discount is important. In some senses, the Royal Banking Commission that looked at the financial industry, they have proposed reform with regard to brokerage industry, and that's going to have some major impact on the pricing as well. There is a regulation that can come about, and that has a major role to play for the transparency and efficiency of pricing.
I want to ask you a question then about a kind of, I mean, in a certain way, I think of it as a kind of psychology, you might say, which is that, for one reason or another, I mean, I'm an American, I grew up in America, then I lived in the UK for a number of years, and then have been in Australia for a number of years. And there's there are similarities, but there are also quite, noticeable differences. So I remember when I was growing up in America, it was quite common for someone to take out a 10, even 15-year fixed mortgage. And then in the UK, you might take out a 5, maybe to 10. And then here, I don't know of anyone who has a fixed mortgage of over 3 years, as you were nominating. So, because I would imagine, you know, particularly with the low interest rates that we're currently in, that there would be an incredible advantage to say, okay, let's lock it in for the next 15, 20 years, the length of my loan at this low rate. But nobody seems to do that. And I'm curious about that differential of it's almost clearly it's a market condition, but it feels almost like a psychological condition that in Australia, nobody would imagine having a fixed rate for more than 3 years.
There are two reasons for that. One, that product is not available. In fact, I have a fixed rate mortgage for 3 years. Most of the mortgages that the banks offer are the variable rate mortgages. And when you go through a broker, they will try and sell you the variable rate mortgages. And it looks lucrative if the interest rates are moving in only one direction, which is going down. So variable rate, they seem good because you would expect, and nobody has seen a longer cycle of interest rate, and these interest rates have been low for quite some time. The second thing is that we don't have institutions like Freddie and Fannie, as in the US, which would then allow these banks to benefit from those secondary market institutions and shift some of the risk which is associated with long lending onto those institutions. So that's something which is lacking in the market here. Now, another interesting factor, which is in case of Australia compared to other markets like US in particular, is that the mortgage market securitization or mortgage-backed securities, they are quite significant in terms of their scale. However, most of these mortgage-backed securities are again owned by these institutions. So that again limits the use of some of these instruments, which you would suggest like fixed rate mortgages in some senses.
But with that, I mean, a question I had, because it only came to me as you were speaking, was, you know, I see, in my experience in Australia, on the one hand, you have the big banks, the big four, and on the other, you have the really substantial superannuation groups. Would there, and I'm sure there's a kind of mix between these, but, you know, if we talk about risk and this question of risk and, you know, how do you sort of support a structure which has some inherent risk in terms of non-payments or default and so on and so forth, would there be a greater role for the superannuation companies to actually act as banks, where they actually take on the role of the lender, because they seem to have a longer term vision than some of the banks do?
Yeah, I think you're right in some senses, because what you're saying here is because superannuation funds and insurance funds, they have a long-term capital in the sense that their assets as well as liabilities are long. So they can take on those mortgage-backed securities because they are looking at those products which give them income for longer terms. So if they take a larger role in mortgage-backed securities market and they demand, say, for example, longer-term product, then the fixed rate would become more available by the banking sector, right? It's not that these institutions don't invest in mortgage-backed securities, they do. But again, they are looking for those shorter-term kind of investment, which will allow them to give diversity into their portfolio rather than having to look for a longer term. So I guess, yes, answer to that question would be yes, they have a role to play. But that, whether it would be a regulatory or whether it would be the market driven, that's another question to debate.
I have a few more questions here. I'll read this one. This is from Rebecca Andre. Any impartial resources you would recommend for borrowers, the layperson like me, to actually educate ourselves on these matters in order to approach purchasing a home loan in a shrewd manner and not get sucked into purchasing an inappropriate project? or
I
product?
think that's a good question. And I'm not sure whether I can direct to any resource which will give us good guidance on how to select. But there are a few principles that one should look at. Try and understand what those discounts are. Try and understand what those costs are. At the end of the day, the model which I presented, where one can convert a fixed rate using a swap and swaption. So these swaps and swaptions could be entered into by any investor. And one can calculate what those efficient rates should be. And then you could negotiate with your brokers or lenders to see what they're offering. And there is always a wiggle room there.
Okay.
At the end of the day, it boils down to individual financial prudence and literacy, because I wish there was a source which one could easily lend to.
There's another question here, which says, is there a relationship between institutional financial risk, stability, and mortgage market inefficiency?
Right, that's a good question. And if I was to think, really, the institutional financial risk, stability, should play a role in the mortgage market inefficiency. But the question is whether I would be sticking my neck out and saying that the big fours were pricing their mortgages because they were facing a risk. Probably I'm not in a position to say that, because I have not done that analysis on their balance sheet and risk that their balance sheet carries. But what it means is that, like, if there is a risk related to the resources or the funding that the banks have, obviously that will play out in the mortgage pricing. But if the market is competitive on the demand side, the supply has to be, because in that case, the banks have to be price takers. They cannot be, they would not be able to dictate a price unless they behave in a collusive manner. So from that point of view, the inefficiency in pricing should not arise in a competitive market. If the banks have inherent high risk, that should affect the bank, not the pricing.
Okay. I want to ask a more, maybe more, well, at least for me, it feels like a more fundamental question, which is that, again, and this is based on my experience of living in various locations, that, you know, in Australia, home ownership is not just an aspiration that has to do with lifestyle, that has to do with, you know, a place where you can establish a family and be located as part of a community in a certain part of a city, for instance. But it's also a financial mechanism. It's a kind of retirement fund. It's almost an adjunct or parallel to a superannuation that, you know, a lot of people have their superannuation, but they have their house as that other asset that they're working towards and such. And there are certainly strong parallels with that in the USA. There's strong parallels with that in the UK. But when you move to places like Germany and France and Spain and other places, it totally changes. And I'm curious if it seemed to me, out of, you know, having lived in most of those places at various times, that Australia is even, you know, I always thought America was all about home ownership, but Australia seems to be even more designated and destined towards home ownership. And does that then play into this whole issue of both the solidity that's demanded upon banks and is supported by the government, but also therefore kind of limiting competition in order to gain stability and solidity, that what the government doesn't want is too much churn. They want to have that stability, you might say.
I think that's an interesting point which you mentioned, Don. When we look at, say, Germany or Switzerland, for example, where the institutions, they own most of the housing stock and rental is the dominant form of tenure. Compared to that, countries like the US, the UK, and Australia are different, because here the ownership is the preferred. And if we look at the household wealth, a large part of household wealth, directly or indirectly, is tied into property. directly through housing, indirectly through their superannuation who invest in property, and so on. So, and over a period of time, if we look at Australian housing market particularly, since 1990s or early 2000, it has given a good growth and good return to the investor and property market. Some other regulation like negative gearing, they also play their part in boosting some of these investment. So from that point of view, it does become much more attractive as an investment asset. Now for the stability of bank, which you mentioned, or stability of the market, you said that like the supportive policies from government, they don't want too much of churn. But having said that, that is important that the financial market is stable, but it doesn't mean that it doesn't have to be non-competitive. Could be competitive, yet stable. The question is, how do you make competitive, right? Now, some of the measures in the Royal Banking Commission report where they say that over-reliance on brokers and aggregators, which was causing some sort of collusion, those kind of things where we need to build competition. And that's where the Rebecca's point, how do a layperson gets better information about pricing and market comes in play. Because if there's a competition, there is no incentive that is linked to how much business do you create for brokers. That would bring in that competition and create that environment where the prudent advice would come in. So some cap on the brokerage and things of that sort, which the commission is proposing, is a good thing, I think.
And there's another question, but before I get to it, do you, just carrying this on a little bit, I mean, do you, somehow I see there's also a paradox or a kind of, I'm going to say a kind of counterbalancing that goes on. So on the one hand, the home is seen as an investment. It's seen as producing equity. It's seen as a kind of retirement benefit that will accrue to it. And on the other, it's a place to live. It's where you raise your family. So there's a sort of stability, neighborhood, community, and so on. But the aspiration to those who have a home that prices should keep going up in order to maximize return is counter to those who are trying to enter the market. Because, you know, so you might take a scenario of a set of parents who are really happy that their value of their property is going up by 10% every year, but that means intuitively that their children will never enter the same market because the prices are going up by 10% every year.
Yeah, I think that's you have said it right, because the asset or investment motivation always have that kind of desire that prices should go up. But the question here is that stocks are also assets. But stocks, when we look at stock market, it fluctuates. So whatever information or whatever fundamentals are there, they get captured in the prices. But it doesn't in housing market. Housing market keeps on building on the expectation and information asymmetrics. So the information that is available in the market is always not perfect. It cannot be priced that efficiently. And the way the system works, particularly, let's say the auction, wherein a kind of competition is created between potential buyers, which leads the prices to always go in one direction. And there's always what we call it as a winner's curse there. So the person who wins the auction again foils it for the next auction of another property. So the prices keep on inflating. So that's the nature of the market that has evolved over a period of time. And it comes out of the inefficiency in the market, general property market.
But that's, I mean, again, you know, I keep coming back to these differential experiences where, you know, in the US, I don't ever remember ever hearing of a house auction. Instead, you set a price, and now you might get gazumped. And I remember the experience in the UK of gazumping, where somebody sets a price and you say, yes, I'll meet that price. And then before you know it, somebody said, well, I'll pay a little bit more. And it goes to the other person. But both my wife and I, when we came to Australia, we had never heard of house auctions, and it being the primary mode of selling, buying and selling, and what that means to a kind of psychology of purchase as well.
Yeah, I think that's an interesting one. And what has happened it goes back to 1960s or 70s, where the Australian big dream used to have a house and car and family and all that. And then there was a secular growth in price. And compared to many of the cities in US where almost like there's a large part of US where the population hasn't grown much or is not growing. And Australia is still growing economy, both demographics wise as well as economy wise. So that has again kept on the momentum of prices to continue to roll upwards. We haven't seen that many downturns here. And those downturns, which we have seen in 90s, for example, they are out of mind of many people. It's too far away. So that keeps again pushing the prices, the general tendency that housing will always appreciate.
Yeah. Well, I remember, I was living in the UK in the 80s when there was a kind of a Margaret Thatcher recession, and, negative equity was a big thing, which I had in a place that I bought. And the same thing for my parents back in Houston in the late 80s as well, where there was a downturn in the oil industry and various other things. And yes, you're right. I think it's partly a question of experience. If you think that everything can only go up, then you act as if everything can only go up and it can only escalate. But it's not true.
No, that's true. This is another interesting story here, because when, say, the prices are going up, people are buying, that expands the mortgage demand. And these banks then hire more financial analysts who are also young, who haven't seen a downturn themselves. So they also want the business to grow. So there is the credit cycle that keeps on feeding the price cycle in the housing market as well. So that also corroborates in some senses. I saw the 2009 crisis in the UK. I was living there, and there was a bank run. There were a few banks who went out of business. There were some in the US. It didn't happen in Australia. Australia survived the GFC. Now, I have my own theory there, which we have written in another paper, which is the nature of loan in the US vis-a-vis Australia. US, the loan is non-recourse loan, which means that if the prices go down below the loan outstanding, one can give the key back to the banks and walk away from home. In Australia, it's not. It's a recourse loan, which means that the risk of price movement is with the borrower. Mm. So if, say, your asset value has gone down, still you have to pay the loan.
All right.
Through your other assets.
Yeah. Interesting. I'm going to, there's a question here from Tony Azigson. Tony, please hold on. I'm going to come back to you. But first, because we've just been speaking about this, there's a question here from Andy Fergus. It says, would love to understand the inflationary effects of auctions and competitive private bidding compared to markets where competitive bidding is regulated or restricted.
Yeah. Recently, two of the economists who got Nobel Prize, they've given the auction theory. And the auction theory is used to kind of discover prices for those commodities where markets are unable to do that. And auctions are one way of doing that. But the problem with auction is that there is always a tendency, it's a behavioral economics rather than anything else, to keep on bidding more rather than when the asset value gets delinked from fundamentals. That's where the problem starts. And that's what happens in a competitive bidding. When two people are competing, there is always a desire to outbid. And particularly with the households who are less informed than maybe, say, in a telecom bidding kind of situation where the corporates who are bidding there are far more prudent. Here, the households who have less information about the product, less information about the market, less information about the goods are entering into a competitive war. And that causes a problem here because it keeps on pushing the prices. And once that property is sold, that becomes evidence for another property. So there is a kind of a spillover effect that we observe.
I mean, I know that firsthand of bidding on a property, and luckily we had a sort of buyer's advocate on our behalf, and they're the ones who kept saying, no, that's it, stop now, it's not worth it. But I think what Andy's question was also about kind of regulation, whether there are regulatory structures that might curb that sort of access, or is it really just the responsibility of the buyer?
I think in a competitive market and the free market, it's the responsibility of the buyer. Now, I remember in Scotland used to be a closed bid auction. It was not like an open auction, but that also has a problem in the sense that all the potential buyers would give their bids as a sealed bid, and their solicitors, one day it would be opened, and whosoever is the highest bidder gets the property, but one doesn't know who they have outbid, really. So it's one again faces the same question, whether I overpaid for a property or not. That remains. So I guess in an auction situation, the problem is that no system is perfect. You cannot mimic a perfectly competitive market. But what Scottish market did, that you were advised by a solicitor who could give some kind of valuation or indicative valuation of a property, which is not required in Australia. You should have a checkbook in your pocket and you can bid. So there is those kind of market instruments which are less developed here. So one good thing will be that you should, if somebody is bidding, they should take advice of a valuer and so on and so forth, look at the information properly.
Right. I'm going to get to this question that Tony Isaacson has provided a little while ago. It says, could a loan provider disrupt the markets by offering quote unquote fair VRMs? And what is preventing or discouraging, say, ME, Australia Bank, or industry super funds offering VRMs at fairer rates?
That's a very good question. And I think one of the conjecture of my last slide was that if we translate that $16 billion per year excess that is being charged on a mortgage to the excess that Australian banks are charging compared to their competitors elsewhere, it would roughly match. So what it is saying here is that the excess profits are coming from overpricing of mortgages. And mortgage is one of the largest businesses of banks. So that is probably preventing them from charging a fair interest rate because there's a profit involved there. And the interesting thing is that in the recent couple of weeks, we have seen many of the banks have announced their profits, which have declined. And a large part of that is due to the Royal Commission related recommendations and also the decline in interest rate on mortgages.
But I mean, at the same time, is it not fair to say that, in a certain way, the bank may, and certainly the big four banks have a certain, I wouldn't call it responsibility, but they certainly have a role in allowing for, the development of property, the development of home ownership, the development of a whole range of fields. But they are also listed on the stock market. So being able to show these very large profit dividends is almost driving, the question of what's driving it, is it the dividend that's driving it, or is it the facility that they offer to the market that's driving it? And, I would suggest that certainly from, a lot of the bank's point of view, it's really the dividend. They're there for their shareholders. They're not necessarily there for their customers.
Yeah, I fully agree with you. And I think your first point that whether they have a role to play in the society as a kind of facilitator of home ownership and uh, making affordable housing available to, they should be doing that. And that should be a social responsibility of these banks. And yes, dividends have become an important role. Like, for example, after Royal Bank Commission, many of the banks had to cut down on their dividends quite significantly.
I mean, Tony extends that and he says, but aren't there competitors coming into the market to compete? Are there, I mean,
There,
is
no,
it?
there are, as I said earlier, that there are barriers to entry. Now, if, say, you control 80% of the market, a new entrant would need information about the borrowers, the market, and so on and so forth. Those are barriers. Now, information is a significant power. Whosoever has it has the monopoly in the market. And that's what is the problem here, because the market share has grown quite significantly. 80% is controlled by, there are numerous small banks in Australia. Nobody knows them, right? And they may be competitive in terms of pricing, but that doesn't affect the pricing in the market because a large chunk is dominated by these.
But is that, I mean, I guess one thought that's been put out there is that with new digital platforms, with new ways in which we can gain data analysis of trends and processes and so on and so forth, is there not the opportunity through these kind of new data platforms and new communication platforms to open up? And clearly there's a lot of online banks that have no physical presence that have started into the market.
And many of them are subsidiary of the big four.
Right. Yes. Well, that's true. Well, I guess that's why I was wondering about the superannuation, because I would have thought that, I mean, although they operate on totally different, it's about money that's coming through a percentage of superannuation, but at the same time, I would have thought they had fairly good data on their customers in terms of what their socioeconomic position is, where they are in their lives, what their assets are to a certain degree. So, I mean, as a competitive group, I would have thought superannuation funds were actually quite substantial as a kind of potential counter to the big four banks.
Yeah, I think that would be an important one. If superannuation funds, they start looking at longer term assets in housing, say, for example, because they are also income generating asset, which that would create a market for fixed rate type of mortgages as you've seen in the US. And the other thing which I also think that there is also a role for these derivative markets to play, like swaps and swaption. I can construct my own variable and fixed rate mortgages depending on whatever it doesn't matter what I borrowed from a bank, by combining it with swaps and swaptions and make it much more kind of adjusted according to my risk profile. So those kind of products are not yet that widely adopted by the individual borrowers. So I guess maybe there is a market information and financial literacy and awareness, those things are needed.
This is slightly off to a different topic, again from Tony Isaacson. It says, the COVID discussion focuses on construction and by inference on home ownership, as well as on population growth as the almost only way to envisage economic growth or as a way out of the recession. How do you see that fitting into this context? Will COVID, in fact, have a pressure one way or the other on some of the sort of fundamental, the kind of foundations that we've been operating on for the last 15 years or so?
I don't see that. Like, the basic premise that we have had right from 1970s, 80s is about home ownership, and that's going to continue in the future as well. Now, what the government initiatives that have been proposed is that, like, for example, there is a focus on building construction, focus on housing activity, homeowner grants, and so on and so forth, these would affect the housing market to some extent, but not to a greater extent, I think. I'm not sure whether I've got the full question right here.
Well, I guess I think it, I mean, I'm interpreting what Tony had put down, but I assume that, COVID is a disruption. It's disrupted all of us. And the question, I guess, of the long-term disruption, we know that, just the fact that our borders are, well and truly closed. Melbourne was projected to be larger than Sydney by 2035, 2040. And a lot of that had to do with inbound immigration.
Yep.
And that inbound immigration was generating, expansion relative to housing, relative to development, relative to construction, so on and so forth. If COVID is not just disruptive for 1 or 2 years, but it's actually disruptive for 10 to 15 years, as a kind of long-term disruption, does that totally, does that have a very profound effect on the assumptions that we've been operating under?
Yeah, I think they would, because it would reduce the number of buyers in the market. And to some extent, we see that evidence in the apartment markets in the city area, where the sales have declined quite significantly and so on. So yes, if a lot of our housing market is dependent on the migrant workers flowing into the economy, so that there is a demand for rental as well as home ownership. And if that stops, that will have an impact on house prices and demand for housing.
I have another question here from Andy Fergus. This is, do you have any suggested reading around the deregulation of banks in the 1980s and the effects of the declining of building societies and mutuals during this time? Because it seems that things weren't always this way, that is, with state savings banks, obviously before the pyramid scheme.
Yeah, I think there is a very good book that was written by Ken Gibb in the UK context, where after 1980s Thatcher's privatization, many of these banks, building societies were deregulated, and that led to a significant growth in the mortgage finance. As the banks entered, there was a lot of money that came into the housing market. So that would be an interesting long-term trajectory of how the banking has evolved and how it has impacted on the housing market. So that's by Ken Gibb, and I forgot the name. I think the other co-author was Satsangi or something of that kind on the building society. But I would be happy to share if I have his email address.
Okay, we can forward that to Andy. In that sense, is there a kind of literature of comparison, that is to say, because yes, I remember living in the UK in the 80s and the 90s, and you would go down to the building society if you wanted to get a mortgage. You didn't go to the bank very often. No. And yet here there's no such thing as a building society, and there's no building societies in America. So I'm curious, is there a kind of almost a composite table that identifies the different ways in which financing, effectively, residential financing takes place, that we in Australia could learn from? The question of how it gets implemented is a different question, but even just knowledge of alternatives.
Yeah, I think there is literature around that, quite significant literature, particularly that relates to the UK mortgage market. But one thing which I would like to say here is that compared to building societies, the banks are much more efficient, in the sense that building societies, they were largely dependent on some kind of bond issuance and so on in order to raise their resources for housing loan, which made their resources expensive, and that then had an impact on the lending rates for housing loans, as well as also it had a kind of some kind of constraint on the credit market as well, the volume. So banks have much larger base through which they raise their resources. Like deposit base is quite big. They can raise through other instruments as well. That makes their pricing relatively cheaper compared to, say, building societies. It should make it more efficient while they are lending as well, because the cost of their borrowings is less compared to what they lend at.
Okay.
So,
I'm going to ask one last question. We're about to run out of time here, but I'm going to ask one last question. And it's probably going to reveal my ignorance to a great degree, but I'm going to try to draw an analogy, which is that, you know, when a major institution like a National Gallery of Victoria or someplace is putting on a big exhibition with very expensive artworks coming from around the world, the state government underwrites the exhibition to do with risk, to do with insurance, and so on and so forth. And so I'm curious as to the degree to which, so this is not about subvention itself. It's not about paying for the exhibition, not paying for the transport or anything. It's just covering the risk, because often when we talk about financial instruments and so on and so on, it's all about managing risk. And so I'm curious if, particularly if we talk about affordable housing, social housing, and otherwise, is there a greater role for central and state governments to underwrite the risk, not to pay for it, but to shift the question of risk in terms of the future so that the prices can come down? The price of borrowing, the price of construction, the price of management and such could change.
I think you're absolutely right. We need secondary mortgage market institutions like the way the US has, like Freddie and Fannie, which underwrites some of those risks which you mentioned, which are completely not here in Australia, and which then has its impact on whether those borrowers, I'm not talking about subprime, but who are less credit worthy than the prime borrowers, can access mortgage. These are the ones who are probably younger household or first time home buyers, or maybe some of those who have less of down payments and so on. There is definitely a need for those kind of institutions, because that's something which has been missing in the market.
Okay, look, I'll call a stop. I mean, fantastic conversation, and to hear all of this, I've learned a huge amount. I really want to thank you for the time and effort. We're at the end of the semester, and you've made yourself available to give this MSD at Home Melbourne Speaks talk. So we thank you very much, Professor TIWARI. And I'll just, in saying thank you for that, but before we leave, I just want to show some of the upcoming events that we'll be having. We did have scheduled for tomorrow evening a talk, again, part of MSD at Home with Melbourne Speaks, with Professor Valerie Francis. Unfortunately, Valerie's not able to do that presentation. She's had a bit of an injury. So we will reschedule that into the new year, into 2021. So please look forward to that. As the chair of construction within the Melbourne School of Design, we very much look forward to hearing from Valerie Francis. We also want to announce that upcoming on the 10th of December, Thursday, the 10th of December, starting at 6 o'clock, we will have our virtual MSDX, our graduating or our student exhibition for the end of semester 2 of 2020. So please join us for that. It's an open and public virtual online exhibition opening, and we hope to see you there. And then on the 17th of December, on Thursday, the 17th of December at 6 o'clock, there's, this is part of the Melbourne Pavilion, or the M Pavilion, M Talks, here nor there, the Power of Boundaries Today. This is the launch, effectively, of the Inflection Journal that's come out, the student-produced journal, really high academic journal that's being produced within the faculty of the Melbourne School of Design. So please join us for that. And for all of our talks, previous talks, and any upcoming talks, they can all be found on the MSD at Home YouTube channel. We try to get, for instance, this talk probably will be available within 2 to 3 days for anybody who didn't get a chance to see it. Thank you again for joining us on this evening, and thank you, Professor TIWARI, for being with us. Goodbye, everyone.